So the ECB has just released its monthly report and it gives more insight into its latest policy decisions. Central Bank makes clear inflation still a top priority as it continues to monitor price developments very closely. It's calling on governments to activate the temporary rescue fund, a sign that the bond buying it recently resumed is only temporary. So too are the bank lending measures which the ECB is using to address market tensions. I want to get more now on the ECB's latest report with Thomas Mayer, Chief Economist at Deutsche Bank, joins us live now from Frankfurt. Mr. Mayer, thank you very much indeed for speaking to us. Wanted to start by asking you about the inflation outlook. It's still a top priority for the European Central Bank. I mean, recently we've seen oil prices falling back a bit. Many analysts and economists saying this could maybe give us a bit more of a breathing room. So is inflation as much of a threat going forward as it has been in the past few months?
No, I think with the signs that we are seeing here, a soft patch globally, but also in Europe, the inflation concerns should subside somewhat. Before all the market turmoil started, we and others were expected inflation to ease towards 2% in the average of next year. With the slowdown perhaps a bit more pronounced than we thought earlier, perhaps inflation will gradually move below 2% in next year.
OK, well, the ECB also calling then on governments to activate the temporary rescue fund. As you well know, the ECB has been intervening, buying Spanish and Italian bonds to try and ease the pressure in the markets that those countries have been coming under. I mean, is this a prospect anytime soon that the EFSF will buy bonds on the secondary market?
Yes, the German and French governments have reaffirmed their commitment to implement the changes to the EFSF by the end of September at the latest. And it's important for the ECB to be able to pass on this task of intervening in the bond market to a fiscal agent. The problem for the ECB is not so much that intervening in the bond markets would lead to inflation or that it would lead to a balance sheet loss, as some people have speculated. I don't think this is the overriding priority for the ECB. The key issue for the ECB is reputational risk, especially here in Germany. Intervention by the European Central Bank in favor of governments that have difficulties funding themselves in the market are seen as highly critical. But then what else are those governments supposed to do? Yes, I think that was the question that the ECB Council asked itself at the telephone conference they had on Sunday. They were dragged into this because of the extreme nervousness of the markets. But it's certainly something that they don't want to do, they shouldn't do. That's why eventually the governments decided to give the EFSF the license to intervene in the market. And this is what the ECB hopes for will happen by the end of September. I mean, what are the risks here? Because the ECB is indicating that its current bond buying program and the emergency lending measures to banks are both temporary policy actions. So once these two tools are withdrawn, what happens in the markets? Do we see borrowing costs start to rise? Do we seeing risk coming off the table? Well, we have to make sure that the ECB stays in the market as long as the EFSF is not able to take over from that. So the ECB over the next weeks will have to show the flag in the market and buy more bonds. Because everyone realizes that the ECB can do this only on a temporary basis and in a limited way, because there are doubts whether the size of the EFSF is large enough then to take over the job from the ECB. Because of all this, there is still market uncertainty of whether this scheme, which the governments have dreamed up, will eventually work. OK, thanks very much indeed, Thomas Mayer. I know you'll be joining us very shortly to discuss this some more. He'll be scurrying up against his counterpart at HSBC to debate the direction of the economy. Stay with us. Bouncing back, US equity futures gain, Europe rebounds after the sell-off. Categorical denial, SocGen rejects rumours over France's creditworthiness. In race against time, the ECB reveals its latest moves to fight the debt crisis.
I want to bring you a snapshot of what's happening on the financial markets right now. Just checking in on three main markets in Europe, and there you can see they are managing to hold on to their gains, rebounding from two-year lows. Bit of a turnaround in sentiment here. All industry groups are higher. Caroline Hyde monitoring all the latest market action for us. Caroline, we're seeing techs, insurers leading the gains, and French banks recouping some of their losses.
Spot on, Maryam. What a difference a day makes. This time yesterday, well, a bit later yesterday, we saw that banks, insurers, they lost 6%. They were the worst performing industry groups in Europe. Look at it today. Banks and insurers are the biggest winners. We're seeing the stock 600 here in Europe rising. And overall, there you can see it in front of your screens. Basic resources up, also tech stocks and banks up more than 3%. The key stocks, Société Générale and Crédit Agricole, those two French lenders. SocGen up more than 7.6% at the moment as investors feel that the stock was oversold. However, what I want to focus in on is now the divergence we're seeing in stock market versus the credit market. Investors are buying back into Société Générale, but credit investors aren't. They are still concerned about the risk that SocGen poses. Therefore, the cost of insuring their bonds against default is rising. Credit default swaps have risen to yet another record. It costs you about €150,000 to insure 10 million euros of SocGen debt. That is a new record. So a bit of divergence there. Elsewhere in the credit markets, well, we can see money coming out of the safe havens, money coming out of German bonds, coming out of US bond treasuries. It's also coming out of gold and the Swiss franc. Now remember that gold investors are having to put up more cash if they want to buy that precious metal. CME, the biggest futures trader, are making investors put in more money to trade gold. That money also coming out of the Swiss franc. But the big winners today, it's the banks, it's the insurers, and is it also the tech stocks?
Great, thanks very much, Caroline. Well, now, August is typically a quiet month for the markets. This one has been anything but that. We've seen trillions of dollars wiped off equities, central banks on alert, contagion risks rising in Europe, and a credit downgrade for the world's largest economy. So these signs of a shaky recovery or something more ominous like a relapse into a global downturn? Well, joining us to debate the issue are two of Europe's most foremost economists. Thomas Mayer, Chief Economist at Deutsche Bank. He comes to us live from Frankfurt. And right here in the studio with me now is Stephen King, his counterpart at HSBC. Thank you, gentlemen, for speaking to us. Stephen, let me start with you. I mean, we're seeing what European stocks rebounding right now. It's been a roller coaster ride for the markets, very volatile. And actually, it's now emerged that volumes are extremely high at record levels. What's going on here?
I think it's a recognition that something's gone badly wrong with the recovery, alongside the fact that something's gone badly wrong with debt. And the two in combination create a vicious circle. The weaker the recovery, the weaker our government tax revenues, the more difficult it is to close deficits, to get debt under control. And the reality is, I think that the Western world is increasingly moving towards what you might describe as a Japan-light scenario. Not quite as bad as Japan, in the sense that Japan bumped into all sorts of demographic constraints which are not true of Western world in total, but nevertheless a constraint associated with deleveraging, very weak levels of growth, all these kinds of difficulties coming through currently.
All right, and actually that sort of echoes what you say, Thomas, which is that the European and the US debt crises are now exploding in the face of the markets. I mean, conditions were already pretty tough without this latest sell-off, weren't they? So how difficult is it going to be now to regain confidence in the markets?
Yes, we saw before we had this sell-off quite some concern about the further development of the global economy, as we have seen some slowdown in the key indicators all over the world. And then we had the additional uncertainty brought about by the debt crisis in Europe and by the debt crisis in the United States. So also I still think that we could get away with a soft patch here. Clearly the risks have increased that we get negative feedback loops between the financial markets and the real economy. If the investors and the consumers lose confidence because they watch what's going on in the stock markets, then the soft patch could actually turn into something more serious.
Stephen, what are the risks of that investors and consumers lose confidence and actually a soft patch then turns into a full-blown double dip?
Well, in one sense, the soft patch assumes there's a recovery shortly afterwards, but the recovery itself has not really ever got going. If If you look at the US over the last 2 or 3 years, the pace of recovery has been remarkably weak compared with previous US recoveries. And in one sense, that's a reflection of all the difficulties previously associated with the housing bubble and the financial crisis. So the reality is that we've thrown a huge amount of resource at the recovery in the sense of fiscal stimulus, monetary stimulus, unconventional stimulus, and it hasn't really worked in the way that was intended. So I would argue that in between a kind of soft patch and a decent recovery or a recession, there's a stagnation scenario. Basically implies that we have continuous weak growth for a long period of time. If we have continuous weak growth for a long period of time, financial assets collectively will have to come down in value.
Thomas, what do you make of that? We shouldn't actually be surprised in the economic wheat patch that you described, the wheat raft of data that we've had, or indeed in these steep declines that we're seeing now in the markets, because a strong recovery never actually materialized.
I think that's right. I mean, we know from historical analysis that economic growth after such severe banking and financial crisis that we have seen now has historically been depressed for quite a while. So that's why I was never expecting the United States to grow on trend very high. In fact, my trend estimate for the US has been for quite some time between 1.5% and 2%. Now, if you get low trend growth, and you get some fluctuations around this low trend growth, which are inevitable as the deleveraging process is not very smooth. You always sort of hit recession risk when you go through a soft patch. And I think from that point of view, we shouldn't be so surprised by what has been going on. Perhaps we were a bit misled by the 2009-2010 developments, believing that things would go back to normal. That's not the case. We know from historical analysis that that can't be the case.
So let me just pick up on the point that you made about US growth, Thomas. What do you think about that? Is 2% growth, Stephen, for the US a pipe dream now?
Well, 2% over the long term is actually a thoroughly miserable number, because the US in the 1980s and 1990s was happily growing at 3% a year. But the reality is that since about 2000, the trend growth rate of the US has been about 2%. I think Thomas is absolutely right on that. But the difficulty has been that people within financial markets, consumers who've borrowed, people who've invested in housing, continue to assume that growth was more like 3. So they continue to assume that future income expansion will be far greater than it actually has proven to be. The difficulty now is that without the gains coming through on the income front, suddenly it turns out that people's debts are far more difficult to cope with, and that sort of deleveraging process makes life extremely uncomfortable.
OK, gentlemen. Well, I'm pleased to say HSBC, Stephen King, Thomas Mayer of Deutsche Bank have agreed to stay with us. Going to be getting more insight from them on what the latest developments in the US and Europe mean for the economic recovery. So much to discuss. Stay with the Pulse.